significantly better than the first half being better than the second half of last year. So then we enter and then Chairman Powell in mid-December comes out and says, we think we've capped out our interest rate growth. And in fact, we'll probably see 3 declines in the year of 2024. And we're trying to get back to that 2% PCE number, inflation number, but we don't think we're going to get there until 2026. And it might be a lumpy ride. So all of that information was very positive for manufacturing. It really just provided us with tailwinds. We entered January and there were signs that we're climbing out of the trough. We had seasonal factors too that weighed in. In February, it wasn't as strong of a signal, but still the signal was there, supported by the comments of some of the underlying indexes moving in the right direction, even though we could not overcome the seasonal headwinds that occurred in February, especially on the new order level. And now we've hit March and we have overcome the seasonal factors. We are expanding on the new order level, and the PMI number has crossed the 50 line. So the official start to the growth profile has likely occurred. We'll need another month to verify that. And this might be a bit lumpy too. We might fall back in 49.3, 49.5. The economists predicted 48.3 for the month of March, and we hit 50.3. Very confident about the numbers. Everything in this report is supported by multiple facts supporting these numbers. For instance, the new order number, came in above 50. We saw the weakest amount of softening comments in the month of March since I've been tracking that, and that I've been tracking it for 2 years. So that's really a positive. Our sentiment was still 2-to-1 positive. We've been at that 2-to-1 positive since December. So again, it's supporting the fact that we're entering a growth cycle. I do think though that the growth cycle is going to be weak. It's not going to be a strong growth cycle. It's going to be a slow grow out. And for instance, I see us kind of sitting in the range now on the PMI of anywhere from 49 to 53, and we'll probably stay that way for quite some time. So it really good report, Dan.
Yeah, I write this a lot when I write about our reports on our website. One of the most user-friendly things of the ISM report on business is when you get a reading that is a little bit higher or lower than you may expect with the composite PMI. You can quickly look at the sub-indexes and they'll quickly tell you why that happened. And obviously, if you look at the 5 sub-indexes that feed into the PMI this month, what stood out to me was the production number. That was a very nice boost to 54.6%. But I remember you talking, and I've observed it as well. Even during the contraction period, the production index that's shown a little resiliency. It's really hung in there, considering the conditions that it was dealing with. So was this increase not that much of a surprise, or just give us an overview of how that index worked out?
Yeah, back to your point here about the resiliency of production. So even when we were in the decline and we entered the trough, our production number pretty much stayed stable, which production is a pretty good surrogate for revenue. So, the last 4 or 5 months of last year, first couple of months of this year, we're hanging around 50 to 40, 48.5 to 50. That's a pretty stable production output, even though we were destaffing and the new order level was very weak. So the reason we were able to maintain that production level is because we were burning off backlog. We were working on the order book that had been inflated during the pandemic period. And the good thing about the soft landing, and we've talked about this before, is that with the Fed 2 years ago increasing interest rates, he didn't throw us into a hard landing, a deep fall, and that would have been, we would have seen prices collapse, we would have seen revenue collapse, order rates collapse. This is really the benefit of a soft landing. Chairman Powell really gave us the ability to burn off the extended supply chain that we had built up during the pandemic, the over ordering. So if you look at the greater supply chain, not only is it inventory at our panelist companies, it's inventory at our customers, and it's the amount of commitments that are outstanding to our supply base. And the amount of commitments outstanding to the supply base was probably 3 or 4 times normal because they had extended all their lead times because of the huge demand increase that occurred after the pandemic. So, with a soft landing, we were able to work off that backlog, which meant we worked off, the backlog index number, and it's been contracting now for 18 months. So, rather than stick somebody with inventory that they can't use, we were able to use those off-book commitments to the point where we kind of cleaned it up. The downside was we weren't getting any new orders, and new orders goes into the PMI number. Backlog does not. But we were able to burn off all that that swelled order book to the point now where new orders are starting to flow in, and we're much better connected with supply and demand. So yeah, I think the production number at the level it came in at was a bit of a surprise. I would have expected more of a 53 to 54. Coming in at 56 to 55 was pretty strong. But okay, that's fine. I mean, coupled with the fact that we're still releasing people, so our hire to force manage ratio is still at 1-to-1. It's been 1-to-1 for 4 months. We started to release people back in the summer of last year. We thought that we were overstaffed given the forecast for late 23 and 24. Plus, 2.5 years of hiring anybody who could speak or walk resulted in the fact that we probably had people that we didn't want to keep long term. So both of those things are occurring. We're releasing people we probably don't want to keep long term, and we're still trying to right size the workforce for the next 9 to 12 months worth of demand. I think that's ending now with new orders now increasing. What probably is left now is to release the final people that we don't want to hold on long term. And I think we're probably looking at an employment number growing again in the June, July timeframe. So that's probably the last index now to get cleaned up here post pandemic. Yeah,
just talk about how that that process. You've been talking about the right sizing process for a while. And I would expect that employment to be kind of a lagging indicator for now at least, and you would expect it to follow new orders and production that same direction. Would that be a reasonable assumption?
Well, if you're maintaining profit discipline, and it appears that our companies are trying to do that. You can't carry excess headcount into a period where your profits are strained. We already know that pricing levels, input prices, material costs continue to rise. You can see it here in our index at 56. Our panelist companies are having to deal with that. So in a lot of respects, that's outside their control. What's inside their control is the amount of headcount and their utilization, operational efficiencies that they're operating at. And as we said back in December, they were operating at 83% of operating efficiency, which is pretty low, which means that they needed to release some people. So I think it's taking its course. It's all fitting well into the story here. We've got demand coming back. We got output remaining at the same levels or slightly stronger as we get closer to half two. We got suppliers stiffening up, but kind of right now sitting at the equilibrium level of supply and demand. And we have manufacturing inventories, working capital being reinvested into. So we're in a good spot, I think.
Yeah. Well, one of the things that I do after the report comes out is I surf the Twitter a little bit and gauge some of the reaction among the the news and business organizations. And other than the fact that it was in expansion for the first time in a while, the composite PMI, the number that's as you might expect that would stand out among that community, the business community, was the prices index number. And you spoke earlier today how that has been consistent with some of the federal data, the index data that we've seen, the CPI and the PPI. So just talk about that dynamic of it. And of course, everyone wants to know what it's going to mean for interest rates. And I know, we're just observers. We're not the Federal Reserve, but, just give us, some of your insights there.
Yeah, I think, this is it's kind of a warning level, but I'm not that concerned about it because, the chairman has said that it's going to be a bumpy ride. And he's already seen other indexes that, weren't meeting the expected profile, which is really a bump. So this might be a bump. I'm not so sure that this is a sustainable level of price growth, 56. Although I do think that this price growth number is demand driven. It's not so much commodity driven, it's more demand driven. I think that the plant utilization numbers are at historically low levels in terms of steel and cement and likely plastics. You see the plastics is a good example. You got natural gas at historic lows, yet the price of plastics is going up. That to me says that the plastics manufacturers can't produce enough fast enough. And as a result, you're seeing prices grow a little bit. The case of steel, probably the same thing. You got utilization at the 78% level. It could probably go a little bit higher, but you're in that period of time where you might have some turnarounds happening, plant maintenance going on. And as a result, you're seeing steel prices grow a little bit. So, and aluminum, you've got up and you've got down. So I don't know that that's going to sustain. It's going to stay that way. I would think the capacity is going to come back into the market and see prices stabilize. But if they don't, then, the Federal Reserve has a choice to make. And as long as they don't raise rates, we're fine. I mean, if they stay higher for longer, that's fine. I don't think that's an issue for us. If rates go up, then, the whole story, the whole trajectory changes.
Yeah. One of the things that I like to do in the calls that we've had here, not only discussing the data itself, but just how to use the report a little bit. And one of the things that I've started to pay attention to a little bit more is the listing of industries and why it's important, to pay attention to their directions, especially the big six industries in the manufacturing sector. Just talk about how why it's important to pay attention to those, and especially in recent months. Just how encouraging it's been, some of the foundational industries that we've talked about in manufacturing, meaning those that provide products and components across the manufacturing sector. Those have been leading the way in the growth. Just talk about how encouraging that's been in recent months. Hey, Tim, I think you're muted.
Oh, thank you very much.
All right.
I wish you had done that earlier.
I just noticed myself.
Okay. So let me restate that.
Yeah.
So, here we are, the top six make up 74% of manufacturing GDP. All of them are at least 49. Most of them are above 50, but they're not much above 50. We're talking 52, 50.5. The big change in the month of March compared to February was really that food and beverage, our number 3 industry sector, returned into expansion. It moved about 6 points, I think, 5 to 6 points. But, we knew January and February is their slowest period of the year, and they're now starting to get back into a normal cycle. So that definitely helped. The other one that helped is computer electronics. We've had trouble with computer electronics. I think that's number 4 of our number 4. And that's starting to get back to a growth profile, which is good. So chemical products did well. Transportation, both of those are 51, give or take. Food and beverage was 47 in the prior month. It's now above 50. That absolutely helped. Computer electronics, number 4, was in the mid 40s, I think, in February, and it's now close to the high 40s. So all the manufacturing sectors seem to be moving in the right direction, as you would have expected. And that's really where the rubber meets the road. Some of them have some pretty strong new order numbers, which is really good. And I think, I'm hoping to see the backlog number get back into expansion territory. There might still be a little bit of unwillingness to release capital without that order book getting back up into a good space. We've been burning off the order book for a long time, as I mentioned earlier. And it's likely that we won't see backlog start to expand again until probably June. But we'll see.
Yeah, that's a good, what you just said there reminded me of another thing that you've been paying close attention to in recent months, and that's the percentage of manufacturing GDP that is in contraction or that is in strong contraction, meaning their own personal PMI readings above, below 45%. And as you pointed out in the report, those percentages have been getting lower and a lot more encouraging in recent months. Just talk about how that dynamic, has worked. And obviously, as you would expect with an overall PMI number in expansion this month, those dynamic numbers you would expect to look really encouraging.
Yeah, so this is what's great about the PMI report. There are so many sub-elements that you can use to validate other things that are going on within the report. And I like to use one or at least one, if not 2 or 3 other vectors to support the fact that we're on the proper trajectory. So This is one of them. So in the month of March, we only had 30% of manufacturing GDP in contraction, meaning 49.9 or less. But more importantly, we only had 1% contracting at 45 or less. That I established as a warning zone. 43 is a real danger zone. 45 is a warning zone. So we only had 1% contracting at 45 or less. That was the same number we had in February. And if you go back, hold on a second, let me get this number because it's a good number to talk about. Back in December, I think we had 40% of manufacturing GDP contract. We had 48% contracting at 45 or less back in December. We're now at 1%. So, clearly another data point that says we're in a growth profile here. I'm going to convert this thing now to percent expanding and percent expanding at 55 or greater. And I think that now that we're not in a contraction cycle anymore, it's time to start to looking at the growth profile metrics. And I'm going to convert this contraction cycle to an expansion cycle. And so next month we'll talk about percents expanding. But yeah, it's another data point that says, yeah, we're definitely in a growth profile here. A couple of others, softening demand. I'm not sure if I mentioned this already. If I did, Dan, step on me because this is like my 5th interview of the day. But
no, you're good.
Softening demand. So only 15% of headline comments indicated softening demand. Softening means that the order rates are diminishing compared to the prior month. That number is the lowest number. We had one month that was a bit of an anomaly, but that number is the lowest number since May of 22 when we had 10%. So, and May of 22 is right after the Fed started to raise interest rates. That's when the new order levels started to really decline. So we're now back on a pretty good profile there. Demand softening is diminishing. The other one I look at is headline sentiment. How many companies are commenting about being positive about the future versus being not so positive? We're still at a 2-to-1 level. We've been 2-to-1 level now since December. So I'm looking for that to get back up to the 5-to-1 level. I think we maxed out here. I'll give you a max out number. We were running at 16-to-1 back in June of 2020. So we got a ways to go, but I think we'll see that number start to pop back up by the time we get to the June timeframe for sure. So a lot of good stuff going on the demand side. I think the soft landing has allowed us to clean up our order book, not only with our customers but also with us, analysts, as well as our suppliers. And that's allowing us now to get much better coupled with true supply and demand. And I think we're there. The last thing we need to do here is get the head count right. And I think that's going to happen in April and for sure May. By the time we get to June, I'm sure we'll be expanding on the headcount side or sitting at a 50 level.
Yeah. Well, yeah, you were confident that, the expansion was in sight for the PMI by March, April timeframe. And I know you've been bullish about the data staying in expansion territory based on what the numbers under the hood say. And I mean, given that, as you point out, the manufacturing growth cycle period tends to last average 2.5 to 3 years. I mean, that's not idle speculation that, things are on an upswing. Just, discuss and elaborate on that a little bit.
Yeah, I mean, there's a lot of parameters here that support the fact that we're now in the growth cycle. The percent contracting is one of them. The demand sentiment is another. And our forecast is a third. I mean, our forecast in December indicated a much stronger 24 compared to 23, and that the first half would be better than the last half of 23, and the second half of 24 would be better than the first half of 24. We're on that profile. It fits really good. We're a couple of months away from our updated forecast. I'm anxious to see that. We usually do that in the April-May timeframe. I'm anxious to see what the latest perspective is, especially in the only question on the forecast was really the huge amount of CapEx that was planned for 24 and the amount that we had spent in 23. That was the only anomaly, that it seemed to be a little bit outsized compared to what the rest of the economy was doing. But okay, nonetheless, I think our operating efficiency is going to get back up to 86, 87%. And like I said, I think by the time we do that forecast, our employment level will be stable, if not expanding again. Everything's aligned. I mean, the fact that manufacturing inventory is getting close to 50, reflects the fact that we're likely reinvesting in working capital. following a year of a lot of concern around liquidity. The 2024 fiscal year is not a liquidity year; it's more of a profit year. So to make money, you got to satisfy demand right away. You got to have product to satisfy your customers, and which means probably an incremental investment in working capital, which I think is underway, and that will support the Q1 GDP numbers. I don't know how we're going to go from 4.8 to 3.4 to what, less than 2%. If you look at the last quarter's GDP numbers, I think we came in at Q4 last year at 3.4% GDP, down from a higher period in Q3 of last year. This first quarter does not feel, it does not, especially on the manufacturing side, it does not feel like a 2% or a 1% GDP growth. It feels better than that. So, but for your listeners, the point here is that manufacturing is generally 6 to 9 months ahead of the general economy. That's the benefit of the manufacturing PMI. It's not so much a great measurement of what's going on with the economy today. The great measurement of what's going on with the economy today is the service sector under Anthony Nieves. That's a really good reflection. It's 90% of the economy. It reflects what's happening today. The manufacturing side is really what could happen 6 to 9 months out.
Yeah. You touched on it when you were asked about it earlier today. I know the collapse of the Baltimore Bridge has been in the news for, since it happened, and it's going to stay in the news for a while, especially as people talk about the potential supply chain impacts. You were confident that, those things could be overcome. In a call that I listened to you on earlier today, just talk about that. I know that's something that's going to be on the minds of probably a lot of listeners, and just want to get an idea of how that could impact, not only supply chains in your eye, but potentially, the PMI numbers. But I know that you said earlier today you expected it to be minimal.
Yeah. So there will probably be some impact on prices. We've had a lot of price growth in ocean freight, which affects a piece of the manufacturing sector for sure. Primarily driven by the Red Sea problems, definitely, and the fact that the Panama Canal is still a little bit underfilled, which is causing some problems there. The Baltimore issue here, I see that as very short term. There's two issues that are going to arise from this: the use of the port, and the second one is the transportation routes, road freight transportation routes affected by 695 going down. I personally had a drive up the East Coast last week, and I was out on the 7781 corridor in Western Virginia, and there was a lot of trucks on that highway, and there was a lot more traffic than I would have expected, but it wasn't overwhelming. And the net impact on my drive up the East Coast was 1 hour. So I don't see that as being significant. Which brings us back to the ocean freight issue. The Baltimore port is a big bulk port, not only with autos, roll on, roll off, which a lot of those apparently are downstream of the bridge, not upstream. So they're still able to operate. There's more of issues around coal exports, sand and salt, which is a winter thing. That's not a big deal. But the summary on this is I don't see any reason why that port is not open in the next couple of weeks, because they got the equipment there to lift the trusses off the ship. The big issue is, does it make the ship unstable? There's smart people. There's a lot of people all over this thing. It wouldn't surprise me if that port reopens somewhat within a couple of weeks. I think they got to get that big ship out of the way to allow big ships to come back in. That may be another week or so after they clear the bridge trusses. But I would think by the time we're on the call next month, the port will be open.
Yeah. Well, we're coming down to the bottom of the hour here in our time. My last question for you is that, this contraction period that is hopefully in the rear view mirror, you've referred to it kind of as an oddball contraction, based on some of the dynamics that, that have been unique to it. Just how did it compare with other, contraction periods that you've experienced and had to work through, and what lessons can be learned?
Yeah, so it went on longer than most. Most of if you look back the last 20 years, we've had 6 expansion cycles. A couple of them supported recessionary periods, the post-pandemic recession and the Great Recession, of course. So, I think this contraction went on longer than the normal ones, primarily because we had to burn off all that inventory, and the fact that the Fed didn't throw us into a hard landing allowed us to do that. So the negative was we had a longer contraction period than normal. The positive is that we're exiting that contraction period in good fundamental business supply demand shape, which I think is really important. I think the fact that we're going to reinvest in inventory will probably be positive to GDP for Q1. And I think we're leaving a lot of the pandemic now behind us. The last index here to really reflect the leaving behind is the employment index. So once that gets to the 50 level, I think we've pretty much left the pandemic behind. Hallelujah! Don't ever come back. Glad to see you go.
Yeah. Well, that's a great way to wrap it up. Thanks for joining us today. For more information, feel free to go to ismworld.org, where you're in a little bit. You can read a roundup article that details a lot of what Tim and I have discussed here, as well as get some of the reaction of the markets. And join us on Wednesday when we discuss the services PMI, as Tim pointed out, a very important metric for the current state of the economy, with Anthony Nieves. He's the chair of the ISM Services Business Survey Committee. For Tim Fiore and some good folks who helped us behind the scenes today, Christina Cahill and Angelo Miller, I'm Dan Zeiger. We'll see you next time.